Hi, gang. Chris Hadley here with Fairway Home Mortgage with a quick market update on what happened in the economy this past week and how you can use it in your conversation with your buyers and sellers. Well, the big news this week was the Fed cutting its key rate. But here's the twist. Mortgage rates actually moved a little higher right after the announcement. So on Wednesday, the Federal Reserve cut the federal funds rate by 0.25%. Now, I think it's important for you to know what and understand what the federal funds rate actually is. So let me start there, and then it'll make more sense as to why mortgage rates actually ticked up when the Fed lowered that rate. So banks are required by law to keep a certain percentage of their customers' deposits in reserve, either physically in their vaults at the bank or at the Federal Reserve. This ensures stability in our banking system. And at the end of each business day, some banks may fall short of the reserve requirement. For example, if withdrawals were unusually high at one bank or they made a lot of loans, other banks might end up the day with excess reserves because they had a slower day. The federal funds market is where these banks lend and borrow money to each other overnight to balance things out. If a bank is short, it borrows from another bank that has excess reserves. This interest it pays is the federal funds rate, the overnight rate. This is the rate the Fed directly controls, and that's the rate they lowered on Wednesday. This rate directly impacts personal loans, car loans, home equity lines of credit, and credit cards, but it does not directly impact mortgage rates, but it does indirectly impact mortgage rates. Mortgage rates, as you know, are tied to long-term bond yields or mortgage-backed securities. And an easy way for you to track this is by watching the 10-year Treasury, as I've talked about before, and just adding roughly 2.5% to the 10-year Treasury yield. So after the Fed's cut, these bond yields actually rose, which pushed mortgage rates up a bit. So why this disconnect? Well, the Fed signaled in its speech, in Jerome Powell's speech, that it's worried about the job market softening, but inflation is still running fairly hot. Investors took that to mean that rates may not fall quickly and inflation risk is still in play. That uncertainty caused bond markets to sell off, and when bond market yields rise, mortgage rates follow. So instead of seeing immediate relief, we actually saw a slight bump higher in mortgage rates on Wednesday and Thursday. We're still hovering around 6.3 to 6.5% for most of our borrowers, so it wasn't a major move, so don't panic. But we started the week about an 1/8% lower, so that's where we saw a little bit of an uptick. So what do you need to know? For buyers, this shows how volatile rates are. Even when Fed cut rates, mortgage rates can react in the opposite direction. For sellers, it means buyers are still facing affordability challenges, which may affect urgency and how aggressively they can be in their offers. Inventory is still tight, but any rate volatility makes buyers hesitate. That's where your role in guiding them through the noise becomes crucial. Big picture, if inflation data cools and the Fed signals more cuts later this year, we could see downward pressure on rates return. But in the short term, volatility is the theme. So the takeaway this week, the Fed cut rates, but mortgage rates ticked up because markets are still worried about inflation. Keep reminding your clients that headlines in the media don't always translate directly to mortgage rates. The key drivers are bond markets, inflation, and investor sentiment. And those can change extremely quickly. So just be on the lookout. Thank you for watching. And as always, I'm here if you need help with any buyers that need to get approved quickly. Happy to get them taken care of for you. Have a great weekend. See you. Bye-bye.